If you've watched the channel before, you'll already know my goal is to retire on dividends. One of the worst things to happen once you're retired is to unexpectedly run out of money and be forced to go back to work. So how do you retire on dividends forever? In this video, we'll take a deeper look at the concept of retiring on dividends. I'll show you ways to assess dividend safety, and at the end, I have an idea for something I think you'll like, but let's see. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Before we get started, let's just make sure we're all on the same page. Dividends are a portion of the company's earnings that is distributed to its shareholders as compensation for investing in the company. They're typically paid out regularly, either quarterly, semi-annually or annually, and sometimes monthly, and are often expressed as a fixed amount per share or as a percentage of the share's price, known as the dividend yield. Dividends work as a way for companies to share their profits with shareholders. When a company generates excess earnings beyond what's needed for growth and reinvestment, it can choose to distribute these earnings to shareholders in the form of dividends. Now let's distinguish between dividend stocks and non-dividend stocks. Dividend stocks are the shares of companies that regularly pay dividends to their shareholders, and these companies are often well established, financially stable, and have a history of generating consistent profits. Investors who are interested in receiving regular income from their investments often gravitate towards dividend stocks. On the other hand, non-dividend stocks are shares of companies that do not pay dividends to their shareholders. Instead, these companies may choose to reinvest their earnings back into the business for growth opportunities or to pay down debt. Non-dividend stocks are typically more focused on capital appreciation, where investors aim to profit from increasing value of the stock over time. Now let's take a look at some examples of well-known dividend-paying companies. Johnson & Johnson, J&J. This multinational healthcare company has a long history of paying dividends to its shareholders, and is considered a staple in many dividend portfolios due to its stable earnings and diversified product portfolio. The Coca-Cola Company, KO. Coca-Cola is a leading beverage company that has consistently paid dividends for a very long time. Its iconic brand and global presence make it a favorite among dividend investors. Microsoft Corporation, MSFT. Despite being known for its growth and innovation in the technology sector, Microsoft has also become a reliable dividend payer in recent years, attracting both growth and income-oriented investors. Microsoft is known as being a dividend growth stock as the amount it pays out increases year on year. Procter & Gamble Company, PG. Procter & Gamble is a consumer goods giant known for household brands like Tide, Pampers and Gillette. It has a strong track record of paying dividends and increasing them over time. If you build a diversified portfolio of stocks that pay dividends like this, you can use these payments to pay for your lifestyle. Once your lifestyle is covered by payments from dividends, or from a combination of sources, you can effectively retire. Now, these examples aren't recommendations to buy, but simply to illustrate the diversity of industries and sectors represented among dividend-paying companies, offering investors opportunities for income generation and long-term wealth accumulation. If you're wondering where you can buy stocks like this, then if you've followed the channel for a while, you'll know that I recommend Trading 212 as the best option for the majority of use cases and users, and in this video it'll be no different. On top of that, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section. Capital at risk. If you've opened a new account recently or are planning to open an account, here it is, DivExp or DIVEXP, short for the Dividend Experiment. So you have up to 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, then thank you for your support, and thanks to Trading 212 for sponsoring this video. The concept of retiring on dividends forever. Retiring on dividends offers a unique approach to achieving financial independence and retirement security, distinct from traditional retirement strategies. Unlike traditional methods, which often rely heavily on savings, pensions, or retirement accounts, retiring on dividends focuses on building a portfolio of dividend-paying stocks that generate a consistent stream of income over time. At its core, retiring on dividends involves accumulating a diversified portfolio of high-quality dividend-paying stocks and living off the passive income generated by those investments. Rather than only relying on a fixed nest egg that you gradually draw down from, or relying on riding through the ups and downs of the market, this strategy of dividend investing aims to create a reliable source of income that can sustain you through your retirement years, hopefully in a less stressful manner too. Instead of withdrawing from a limited or finite pool of savings or investments, retirees can rely on the ongoing dividends produced by their portfolio to continually cover living expenses. This passive income stream provides a sense of financial security and stability, allowing retirees to maintain their lifestyle without the fear of outliving their savings. Another distinguishing feature of retiring on dividends is the pursuit of financial freedom. By building a portfolio of dividend-paying stocks that can sustain their lifestyle, individuals can potentially achieve a level of financial independence that allows them to pursue their passions, interests, and goals without being tied to a traditional job or career. This freedom to choose how to spend their time and resources is a significant benefit of the dividend retirement approach. Another thing to consider is the resilience of dividend-paying stocks during market downturns. Historically, dividend-paying companies have demonstrated greater stability and resilience during economic downturns compared to non-dividend-paying stocks. This is because dividends can provide a cushion of income for investors, even when stock prices are declining, helping to offset losses and preserve capital. Additionally, retiring on dividends offers a degree of flexibility and adaptability. Since dividend income is typically more stable and predictable than other forms of investment income, retirees may have more flexibility in adjusting their spending patterns or managing unexpected expenses. This flexibility can be particularly valuable during periods of economic uncertainty or market volatility. Challenges and risks. Retiring on dividends, while promising, is not without challenges and risks. It's essential to be aware of these potential pitfalls and have strategies in place to mitigate them effectively. One significant challenge is market volatility. Stock prices can fluctuate significantly in response to economic conditions, company performance, or market sentiment, and during periods of market volatility, dividend-paying stocks may experience price declines, which can impact the value of your portfolio and the income generated from dividends. Another risk to consider is the possibility of dividend cuts. While dividend-paying companies strive to maintain or increase their payouts over time, in an ideal world, there are instances where they may be forced to reduce or suspend the dividends due to financial difficulties or other factors. This can result in reduction in your income stream and potentially affect your ability to sustain your desired lifestyle in retirement, which is obviously not good. Mitigation strategies. Diversification. One of the most effective ways to mitigate your risks associated with retiring on dividends is to diversify your portfolio. By spreading your investments across different sectors, industries, and geographic regions, you can reduce the impact of these adverse effects affecting any single company or sector. If there's a downturn in the mining sector, for example, then your mining stocks will suffer from that. However, your stocks in, say, healthcare or finance or elsewhere may be completely unaffected. Focus on quality. Prioritize investing in high-quality, dividend-paying companies with strong fundamentals, such as solid earnings growth, healthy balance sheets, and a history of consistent dividend payments. These companies are more likely to weather economic downturns and maintain their dividend payouts over time. Remember, if you want my 10 dividend commandments or rules for dividend investing, you can get that for free just by signing up to the email in the pinned comment below. Monitor portfolio health. Stay vigilant and regularly review the health and performance of your dividend portfolio. Keep an eye on the financial metrics, such as dividend payout ratios, earnings growth, and dividend sustainability, and you'll need to be prepared to adjust your portfolio as needed in response to changes in market conditions or company fundamentals. Emergency fund. This is something I talk about a lot on the channel, but you need to maintain an emergency fund or cash reserve that's separate from your dividend portfolio to cover unexpected expenses or income disruptions. Having a financial buffer can provide peace of mind and help you weather temporary setbacks without having to dip into your investment principal. Stay informed. Stay informed about economic trends, market developments, and changes in company fundamentals that may affect your dividend investments. Stay connected to reliable sources of financial news and analysis to make informed decisions about your portfolio. By implementing these strategies and staying proactive in managing your dividend portfolio, you can mitigate the challenges and risks associated with retiring on dividends and protect your income stream in retirement. Now, here's the idea that I mentioned at the beginning of the video. These things here that I've just mentioned are good for keeping your overall portfolio in good health, but what about the individual stocks themselves? I have my own 3-factor framework for dividend safety, where I look into just how likely a stock is to cut its dividend in the short to medium term. The 3 factors I look into are financial reasons, management reasons, and external factors. I'm thinking about making this a full PDF guide with step-by-step instructions on how exactly I go through this process and what I look for. I'll probably throw some examples and case studies in there too for good measure. If you're interested, then let me know by liking this video or leaving a comment, as I don't want to take time away from the things that you do like to make things you're not so interested in. But if it is something you're keen on, definitely let me know and I'll get to work. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!